Hi, we are in the topic of guarantee of profits to partner. In the previous video, we saw the journal entries that need to be passed and also the ledger account that needs to be prepared where the firm earns a profit and any specific partner is guaranteed minimum profits. In this video, we will see the journal entries and the ledger accounts that need to be prepared where the firm incurs a loss and a specific partner is guaranteed minimum profits. Where the firm incurs a loss. Example: A, B and C are partners in a firm sharing profits in the ratio of 3:2:1. C is guaranteed a minimum profit of rupees 15,000. Any deficiency arising on this account is to be borne by A and B in 1:1 ratio. The firm incurs a loss of rupees 60,000 for the year ended 31st March 2019. Now we find that in this problem, the firm has incurred a loss of rupees 60,000 for the year. The profit sharing ratio is 3:2:1. So on dividing the 60,000 in 3:2:1, we get A's share of loss as rupees 30,000, B's share of loss rupees 20,000 and C's share of loss rupees 10,000. Again, C is guaranteed a minimum profit of rupees 15,000. Now, when C gets loss as the share, the mode of calculating the deficiency is to add the guaranteed minimum profits, in this case 15,000, along with C's share of loss, which is rupees 10,000, and this would make the deficiency total equal to rupees 25,000. This deficiency of rupees 25,000 is to be borne by A and B in 1:1 ratio. So A will bear rupees 12,500, which is 25,000 into 1 divided by 2, and the deficiency to be borne by B also is rupees 12,500. So let's have a look at the journal entries that need to be passed in this case. The first entry is to distribute the loss among all the partners in their profit sharing ratio. Since there is no interest on drawings, the loss will be directly distributed to partners' capital account from the profit and loss account itself, and the journal entry for distributing this loss of rupees 60,000 is A's capital account debit rupees 30,000, B's capital account debit rupees 20,000 and C's capital account debit rupees 10,000. To profit and loss accounts rupees 60,000. The loss of 60,000 is directly transferred to A, B and C from the profit and loss account itself in their profit sharing ratio, which is 3:2:1. The next journal entry is for the deficiency being borne by the guaranteeing partners. For this, we need to credit the guaranteed partner with the amount of deficiency. The partner who's given the guarantee is C, and we need to credit C's capital account with the amount of deficiency, which in this case is rupees 25,000, and debit the partners who give the guarantee in the ratio in which the guarantee is to be given. So we'll debit A's capital account with rupees 12,500 and B's capital account also with the deficiency to be borne by B, which is again rupees 12,500. So the journal entry would be A's capital account debit rupees 12,500, B's capital account debit rupees 12,500 to C's capital account, which is 25,000. So as far as journal entries are concerned, the first entry would be to transfer the loss to the partner's capital account in their profit sharing ratio, and the next entry would be to ascertain the deficiency, credit the guaranteed partner with the amount of deficiency, and debit the guaranteeing partners with the deficiency which has to be borne by each of them. As far as ledger accounts are concerned, we will need to prepare the profit and loss account as well as the partner's capital account. We will first see the ledger account of profit and loss account. Profit and loss account for the year ended 31st March 2019. The losses will be brought down to the debit of the profit and loss account, rupees 60,000, and these losses will be transferred to the partner's capital account in 3:2:1 ratio. Loss for A is rupees 30,000, share of loss for B rupees 20,000, and share of loss for C is rupees 10,000. Next, the ledger account, which is the partner's capital account. Apart from bringing down the balance of the partner's capital account, we need to distribute the loss to the partner's capital accounts. So on the debit of the partner's capital accounts, we will write to profit and loss account, A share of loss being 30,000, B share of loss 20,000, and C share of loss rupees 10,000. So the losses have been transferred to the partner's capital account, and for the deficiency to be borne by A and B, we'll write at the end of the accounting period, by A's capital account under C, the deficiency to be borne by A, which is 12,500 rupees, by B's capital account under C, the deficiency to be borne by B, which is 12,500, and to C's capital account under A, we'll write 12,500, and under B we will again write 12,500, and we can go on to balance the partner's capital account. So these are the two ledger accounts that needs to be prepared. The profit and loss account, where the losses will be brought down and transferred to the partner's capital account in their profit sharing ratio, and the partner's capital account also, to show how the deficiency is being borne by the guaranteeing partners. So here in this video we learnt about the journal entries that need to be passed and the ledger accounts that need to be prepared where the firm incurs a loss and any specific partner is guaranteed minimum profits. In the upcoming video, we will be doing example sums on this concept.